All right. Good afternoon, everyone. My name is Amanda Van Schaik, financial advisor, CUSO Financial Services at Wright-Patt Credit Union. In this presentation, we'll take a look at some general financial planning concerns. And while there's no such thing as a one size fits all financial plan, this overview should assist you in thinking about your own needs. There's a lot of ground to cover, even with an overview. So, here are some topics that we are going to touch on. We're going to talk about setting goals. Doing so is really the first step towards developing any financial plan. And then we'll discuss constructing a budget, creating an emergency fund, and then we'll touch on insurance protection. In many cases, you may need to incorporate credit into your financial plan. So we'll discuss some credit fundamentals. We'll also talk about some basic investment concepts and how understanding pre or after tax allocations along with tax deferred growth can help you pursue your goals, such as saving for college and planning for your retirement. And last but certainly not least, we'll look at the rudiments of estate planning. So let's get started. One of the first steps in financial planning are setting goals. And when you set goals, you're defining your dreams for the future. Some of your goals may be things that you want to do in the not so distant future, like pay off your credit card debt or buy a new car. Other goals may be more distant. Do you want to buy a new home, start your own business, or pay for college for your children or grandchildren? Maybe retire early. Your goals are the foundation of your financial plan because you need to know what you want to accomplish before you can begin saving or investing. Once you've identified and prioritized your financial goals, you can develop a clear cut savings or investment strategy that can help turn your dreams into reality. Making your goals as concrete as possible will help you focus on what's really important. A goal that will define will be a goal that's well defined will be easier to visualize and easier to stick with. And to set clear cut goals, you can use the SMART technique. SMART is an acronym that stands for specific, measurable, obtainable, relevant, and timely. A goal that is specific is one that is clearly defined and described in detail. Precisely what do you want to accomplish? I want to save for my child's college education is not as specific, but I want to save the cost of 4 years at homegrown university by the time my daughter turns 17 is clearly defined. With a goal that's measurable, you should be able to track your progress and clearly know when you reached it. For example, I want to retire early is not a measurable goal. But I want to retire by my 55th birthday is a goal that has a defined endpoint. Attainable goal is realistic and reachable. Goals can be challenging, but you should have a fair chance of achieving them. I want to save $1 million in 5 years is not an attainable goal for many people, but I want to save $1 million in 30 years may be well attainable. Relevant is one that makes sense to you and that reflects your specific needs and your values. Goals that are relevant are goals that you will be excited about because they will be important to you. For example, I want to save $25,000 for a down payment so I can own my own home is an example of a goal that might be relevant. And lastly, you must be able to set a time frame or a deadline for reaching your goal. I want to pay off my credit card debt by the end of next year, is a goal that has a clear deadline. And writing down and prioritizing your goals is an essential first step towards putting a financial plan into action. The first part of putting any financial plan into action requires you to control your flow of money. That's part of what a budget is all about. A budget tracks your income and expenses, and it helps you direct the flow in the way you want it to go. To construct a budget, first account for all of your income. This includes paycheck plus any income you might have from other sources such as rental income or government benefits, interest on money you have in the bank, or investment income. From that, you'll need to subtract your expenses. Expenses can be broken down into two categories. Fixed expenses are those that you pretty much have to pay, such as rent or mortgage, car payments, insurance, utilities, groceries, basic clothing. Discretionary expenses are more optional items, such as eating out, entertainment, gifts, and vacations. It can be difficult to get a handle on many of these numbers, especially the expense items. You may want to keep track of them for a while, either with a paper and a pen or on a computer software program to find out how much you're spending. And remember that not all your expenses occur on a weekly or monthly basis. Some are seasonal, like holiday gift expenses or home heating costs. Others are occasional, like car repairs or getting a cavity filled. It may take several years of tracking some expenses to get a good idea on what you spend on average per month or year. Now, subtract your average expenses for a given period, say a month or a year, from your income for that same period. Is there a positive number left over? If so, you're in the black or running a surplus. A surplus can be converted into savings or an investment for the future. But if you get a negative number, that's not good. You're in the red or running a deficit. You're spending more than you're making. And the only thing that's going to change that equation is either increasing your income, perhaps through a second job, or decreasing your expenses. And that's the discretionary expenses, the fun stuff that are easiest to reduce, or you could do a combination of both. So let's look on the bright side. You're running a surplus. One of the first things you want to do with that surplus is create an emergency fund. An emergency fund is money that's readily available to meet unexpected expenses, is really the foundation for any successful financial plan. Without money to fall back on when an unexpected expense crops up, you may be forced to tap savings that you've earmarked for retirement, college, or another savings goal. But if you have an emergency fund, it will be much easier to handle a job loss, a temporary disability, or other event that might prevent you from saving for the future or even tempt you to pile up debt. So, how much should you have in your emergency fund? A popular rule of thumb is that you should have an emergency fund equal to 3 to 6 months of your living expenses. But should you save 3 months, 4 months, 5 months, or 6 months worth of your expenses? The amount that you should have depends on many factors. How stable is your income? Do you work in an industry where layoffs are common, or are you in a growing field? Do you have adequate health and disability insurance? Do you have other assets that you could tap without penalty in an emergency? And where you keep your emergency fund is also important. In a jar is probably not the best idea. You'll want to keep your money in an account where it's readily available, but you'll also want to receive as high of a return as possible. Rarely do you write one check equal to 6 months or even 3 months worth of expenses, so You may only need part of the funds in something as liquid as a savings or checking account. The balance of the emergency fund can be held in something getting you a better return, but that you can still access in a day or two. Another important part of financial planning is identifying and managing the potential risks that can impact your finances. The value of insurance is that it's a cost effective way to mitigate or share the frequently overwhelming cost of various risks. So let's spend a few moments looking at the types of risk you might want to insure against. What used to be called health insurance has actually been replaced by healthcare plans. Most plans provide basic coverage for common medical expenses such as doctor visits, preventative care, diagnostic testing, hospital and extended care, emergency services, and prescription drugs. Auto insurance has two main components: liability insurance and insurance for property damage. Liability insurance provides compensation to persons who would be able to sue you for personal injuries, medical payments, loss of earnings, or damage to their property. Property damage insurance includes collision and comprehensive coverage, which compensate you for damage to your car caused by another auto or such thing as fire, theft, and vandalism. Life insurance offers income replacement to your survivors. It can provide an income tax free death benefit and can be used to pay for funeral expenses and medical expenses in case of an illness. The cost and availability of life insurance depends on factors such as your age, health, and the type and amount of insurance purchased. For most of us, our most valuable asset is our home. Most common type of homeowners policy used today covers a variety of risks that can cause damage to your home and personal property, medical payments for injuries to occupants and to persons injured by accident while in your home, and loss or theft of personal property. Liability insurance is often your last line of defense against potentially devastating claims for things over which you may have little or no control. It's often called an umbrella insurance because it's carried over all other liability insurance and usually adds, say, $1 million or more in extra coverage to your homeowners and automobile liability policies. Coverage is provided for you, your spouse, and any relatives living in your household and insured by your primary policies. What if you couldn't work for an extended period of time because of an injury or an illness? How would you replace your earnings? Who would continue to contribute to your retirement savings accounts or educational funds? Disability income insurance benefits can be used to help preserve your independence, maintain your lifestyle, give you time to recover, and provide a chance to train for another job if necessary, and conserve your assets and savings for you and your family. What is long term care insurance? It's private insurance that pays benefits if you need extended care, such as nursing home. And like other types of insurance, long term care insurance helps protect you against a specific financial risk. In this case, the chance that the need for long term care will wipe out your entire life savings. A complete statement of coverage, including exclusions, exceptions, and limitations, is found in the long term care insurance policies. Okay, so now you've established an emergency fund and you've insured yourself against certain risks for your financial security. And to meet your normal expenses, you planned a budget. But sometimes you need more funds than your budget might cover at the moment, and that's where credit comes in. A word of caution here: don't rely on credit to cover your normal living expenses. If you do, you could be heading down a path that may lead to financial disaster. If you're using credit to pay for normal living expenses, it should be because it's convenient to do so and not because you don't have those expenses planned for in your budget. Merriam Webster's dictionary defines credit as the provision of money, goods, or services with an expectation of future payment. When it comes to financing big ticket items such as college education, home, or even a car, most of us will need some sort of a loan. And there are times like shopping for Christmas or going on vacation where it's just more convenient to use credit in the form of a credit card to make those purchases. So, how do creditors decide to grant credit? It depends on how well you meet the three C's. Creditors will want to know that you have the capacity to repay the credit they grant you, and they'll want to know about your income and your expenses. So, once a creditor determines that you can repay a loan, the next question is, will you? This is a matter of your credit character. And to measure this, they look at factors that measure your stability. How long have you had the same job? How long have you lived in the same place? And if you've used credit before, they'll also want to look at your repayment track history. Do you pay your bills on time? Particularly for loans of larger amounts like a car loan or home mortgage, a creditor might also want some collateral. Collateral is the tangible property that secures the credit extended to buy it. If you default on repaying that loan, the creditor would be legally entitled to take repossession of that property as a form of compensation. Creditors determine your credit worthiness primarily by examining three documents. The credit application that you fill out with a potential lender will ask for your personal information. It will also ask you about your income, its sources, and may ask you your recurring expenses and other debts. Your credit report will give a potential lender a wealth of information about your payment history, and your credit score comes from a statistical formula that analyzes the information on your credit report, compares your profile to thousands of other similar profiles, and produces a three-digit number that predicts your level of future credit risk. The information gleaned from these three documents may not only determine whether you can get credit, but also what interest rate and other terms you are offered. When you are granted a loan or use credit card, you create a debt. Some debts may be small, like a minor purchase on a credit card, and may be repaid quickly. Others are large, a home mortgage or student loan, and may take years to repay. How well or poorly you meet the repayment schedule for the debt will have an ongoing effect on your credit history and your credit score. So, debt may be divided into two basic types: secured debt and unsecured debt. And eventually, you may have some of both. Secured debt is debt that is backed by a lien on collateral. Those examples include mortgage or home equity loan, car loan, or a secured credit card. Unsecured debt does not place a lien on any real or personal property to secure it. Examples are unsecured debt are personal installment loans, student loans, and most credit card accounts. When you think about taking on debt, there are several important considerations. The amount you borrow obviously will have a big impact on the size of your payment. And no matter what term, which term means the length of time you have to repay it, or the interest rate you're charged, you'll need to consider that within the review of your budget. When looking at an installment loan, the term of the loan is the length of time you have to repay it. Generally, larger loans have longer terms. And while longer terms help make your payments smaller, Remember that longer term also generally results in a higher total interest payment over the life of the loan. Revolving credit accounts, such as credit cards, don't have a fixed term for repayment. Instead, it's based on a percentage of the current balance due that is expected each month. And the smaller that percentage is expected to be, the longer it can take to repay the entire balance. The interest rate you're charged on a debt also affects the total interest you'll pay on the loan. The higher the rate, the greater the interest charge will be. Now that we've talked about using credit and the potential for accumulating debt, let's talk about investing and the potential for accumulating wealth. Do you associate investing with speculating or gambling? Do you think of it as betting on what the market will do or try to time the market in order to make a quick profit? Or do you think of investing as more of a long term methodical saving effort to build for the future? Well, it's a little bit of each. Investing involves taking a certain amount of risk, and it also involves the desire to multiply your money over time. And done properly, investing is a carefully planned and prepared approach to managing your money with the goal of accumulating the funds you need. And planning your investment strategy is about discipline and patience. All investing involves risk, including the possible loss of principal, and there is no guarantee that any investment strategy will be successful. When it comes to investing, there's a direct relationship between risk and return. That is, in general, as the potential for return increases, so does the level of risk. Or, stated another way, the less risk an investment has, the lower the potential for return. The investment plan that's appropriate for you depends largely upon your level of comfort with that risk, what's known as your risk tolerance. And you can't completely avoid risk when it comes to investing, but it is possible to manage it. And there are two key questions that determine your risk tolerance. First, how comfortable are you personally with risk? This is a subjective measure and it depends on many factors, including your financial goals, your life stage, your personality, and an investment experience. Some investors are comfortable with a high degree of risk, and others can't tolerate very much at all. And a lot of people fall somewhere in between. The second key question is how well your investment plan set up to handle potential losses. The more resilient your overall plan is when faced with any potential losses, the more risk it might be able to take on. For example, time can be a powerful ally. The longer you're going to be invested, the more flexibility your investment plan might have to survive those setbacks along the way. There are several key terms that you'll need to understand when planning your investments. These three words are probably familiar, but have very specific meaning when it comes to investing. We all know we want our money to grow, right? So when it comes to investing, growth means that an investment has the potential to grow in value. If that happens, you might be able to sell it for more than you paid for it. Income comes from regular payments of money. Interest on a savings account is income. So is interest on a certificate of deposit or CD, interest paid by a bond, and dividends paid by stock. Stability, the third potential objective of an investment, refers to protecting your principal. An investment that focuses on stability concentrates less on increasing the value of that investment and more on trying to ensure that it doesn't lose value. As much as we might like to, we can't have it all. There is a relationship between growth, income, and the stability of our investments. The more important one of those areas become, the more you may have to trade off in terms of the other two. The key is to tailor your investments according to what you want them to do for you and to balance that stability, income, and growth so that you potentially enhance your overall returns at a level of risk that you are comfortable with. So, before we talk about some specific investment vehicles, let's first mention some important tax considerations. Your employer may allow you to cover some ongoing expenses with pre tax dollars. Pre tax dollars are funds that are taken from your pay before certain taxes are on your pay are calculated. So, for example, your federal income tax. Your taxes are then calculated on your remaining pay, and this creates a tax savings for you. So, for example, if you're in a flat 22% tax bracket and you're allowed to buy a $100 commuter pass with a pre tax dollars, that pass really only cost you $78 in after tax or take home pay. The result can be a lower out of pocket expense for you. And some opportunities, if your employer offers them, where you might cover expenses with pre tax dollars, may include paying your health insurance, disability insurance, dental insurance, and vision insurance premiums. Your employer may also allow you to contribute pre tax dollars to a flexible spending account or FSA for either medical expenses or dependent care expenses. With an FSA, your contribution pre-tax earnings to the plan and submit the qualifying expenses to the plan for reimbursement. Your employer may also offer a retirement plan like a 401k, 403b, or a 457 plan. What these plans have in common is that they allow you to elect to contribute a percentage of your earnings on a pre tax basis. These plans are intended to be used to save for retirement, and they offer advantages that go well beyond the fact that you get to fund them with pre tax dollars, as we'll discuss later. Another tax consideration is that some specific investment vehicles allow for tax deferred growth. So, whether you're investing pre tax or after tax dollars, tax deferred growth basically means that you won't owe any taxes on the growth of that investment until you withdraw the funds from the account. And in certain cases, qualified withdrawals from these investment vehicles may be tax free. Some examples of investment vehicles that qualify for tax deferred growth are 529 college savings plans and prepaid tuition plans. A 529 plan is funded with after tax dollars. Your investment grow tax deferred until you withdraw the funds at that time. If the funds are used for qualified educational expenses, the funds may be withdrawn tax free. Both traditional and Roth IRAs also allow tax deferred growth. In the case of traditional IRAs, your contributions are made with after tax dollars, but they may, if you qualify, be tax deductible on your federal income tax return. This is important because tax deductible contributions lower your taxable income for the year, saving you money. And funds in a traditional IRA are sheltered from federal income tax until withdrawn. As for Roth IRAs, if you qualify on the basis of your income to contribute to one, your contributions are made with after tax dollars and aren't tax deductible. But the good news is that if you meet certain criteria, your withdrawals from the Roth IRA, including any investment gains, will be completely free from federal income tax. With most of the investment vehicles mentioned, for example, the 401k, IRAs, and 529 plans, a 10% penalty tax applies if you take distributions before a certain age or for a non qualifying purpose. So let's illustrate the value of tax deferral. Let's assume that you have $20,000 to invest. You put 10,000 into a taxable account that earns 6% per year and use a portion of these assets each year to pay taxes attributable to the account's earnings. And you put the other 10,000 into a tax deferred account that earns 6% per year. Assuming that a tax rate, oops, sorry about that. Let's get back to that previous slide. Assuming that a tax rate of 24% applies, in 30 years, your taxable account will be worth $38,104. In the same amount of time, your tax deferred account will have 57,435. Of course, the funds in the tax deferred account might be subject to federal income tax when withdrawn, but even if you took the entire amount in the tax deferred account as a lump sum distribution after 30 years and paid tax on the full amount, you would still come out ahead in this example at a tax rate of 24%. So, but again, depending on the specific tax deferred vehicle, an additional 10% penalty could apply if you took that distribution before a certain age or for non qualifying purposes. Okay, so now that we have some understanding of investing either pre tax or after tax in vehicles that allow tax deferred growth, let's look at a couple of things you might be investing for. For most people, the two biggest life events they need to save for are college educations for their children and funds for their own retirement. So let's spend a few moments talking about saving for college. Perhaps your potential Harvard graduate is still in diapers, but given the high cost of college, you'd be smart to start a systematic college savings plan now. And one of the options available for saving for college is a 529 plan. Because this savings vehicle offers the advantage of a tax deferred growth, it should be the cornerstone of any college savings program. So, what is a 529 plan? A 529 plan is a savings vehicle that is governed by the federal government but offered by states. Anyone can open a 529 plan, and there are actually two types of 529 plans: college savings plans and prepaid tuition plans. A college savings plan, which is the more popular type, is an individual investment account to which you contribute money. Your money is allocated to your choice of one of the plan's pre established investment portfolios, which generally range from conservative to aggressive in their amount of risk. Returns aren't guaranteed, but money in a 529 plan can be used to pay the full costs, such as tuition, fees, room, board, book, supplies, at any accredited college or graduate school in the United States or abroad. For student loan repayment, there is a $10,000 lifetime limit per 529 plan beneficiary and 10,000 per each of the beneficiary siblings. And for K through 12 tuition expenses up to $10,000 per year. Almost every state offers the 529 college savings plan, and you can join any state's plan. The second type of 529 plan is a prepaid tuition plan. As its name suggests, when you join this type of plan, you actually prepay your child's college tuition at today's prices. The contribution you make today is generally guaranteed to cover a certain percentage of college tuition tomorrow. However, you are typically limited in your own state's prepaid tuition plan, and your child is limited to those colleges that participate in the plan. So, those are generally in state public colleges. The main benefit of a 529 plan is that your contributions grow tax deferred and earnings are tax free at the federal level when they are withdrawn to pay the beneficiary's qualified education expenses. Note, however, that withdrawals that aren't used for qualified expenses are subject to federal income tax as well as a 10% tax penalty. And additionally, there are fees and expenses associated with both types of 529 plans. Finally, it's important to note that if you are considering a 529 plan, it generally makes sense to start by checking to see if there's a plan offered by your state, since that plan might provide favorable state tax benefits to residents. These other state benefits may include financial aid, scholarship funds, and protection from creditors. And you should always read the issuer's official statement carefully and obtain their prospectus. So, now the other major life event you need to save for is your own retirement. Even if you feel you're too far away from retirement to start thinking about it, it's important that you start planning now. Many people assume they can hold off for saving for retirement and make up the difference later, but this can be very costly mistake. The further off your retirement is, the more time you have for your investments to have the potential to grow. Waiting too long can make it very difficult to catch up, and only a few years can make a big difference in how much you'll accumulate. For example, invest 30,000 every year starting when you're 20 years old. If you retire at age 65, you will have accumulated almost $680,000. And that's just assuming a 6% annual growth rate and no tax. If you wait until age 35 and start saving 3,000 annually, you'll accumulate about 254,000. And if you wait until age 45 to start saving that same amount, you'll accumulate about 120,000 by the time you retire. So this doesn't mean that there's no hope if you're 50 years old and you haven't set aside anything for retirement yet. It just makes it all the more important that you implement a plan today. Of course, this illustration is only to make a point. Before you can start planning for your retirement, you need to ask yourself three basic questions. What kind of retirement do you want to plan for? When do you want to retire? And how long will retirement last? So close your eyes for a second and picture your own retirement, whether you see yourself on a golf course, a yacht, a hammock, or simply in your own living room. Most of you probably imagine some degree of financial independence. To a large extent, maintaining that financial independence in retirement depends upon the lifestyle that we want. And you thought about when you'd like to retire? It's important because the earlier your retirement is, the shorter the period of time that you have to accumulate funds, and the longer the period of time that those dollars will need to last. Although you can retire anytime, most people wait until they're eligible for Social Security retirement benefits. You cannot start receiving Social Security benefits until age 62, and the earliest you can receive full Social Security retirement benefits is age 66 to 67, depending on the year that you were born. Also, you're not eligible for Medicare health coverage until age 65. So if you want to retire before then, you'll want to plan for private health insurance. And as we just discussed, the earlier your retirement, the longer the period of time that your funds will need to last. But how long should you plan for your retirement lasting? Keep in mind that life expectancy has increased at a steady pace over the years and is expected to continue increasing. The point that I want to make is that for many of us, it's not unreasonable to plan for a retirement period that lasts for 25 years or more. One of the best ways to accumulate funds for your retirement is to take advantage of special tax advantage retirement savings vehicles. Some of these, such as 401k plans, can be very powerful saving tools because your contributions come out of your salary pre tax, reducing your current taxable income and also grow tax deferred until withdrawn. And 401k plans can include employer matching contributions, a form of free money, which should make them your first choice of saving for retirement. You may also be able to make Roth contributions to your 401k plan since they're after tax, not pre tax contributions. Roth 401k contributions don't provide you with an immediate tax savings, but they allow you to make withdrawals completely free from federal income taxes under certain circumstances. Traditional IRAs like 401ks feature tax deferred earnings growth and can lower your current taxable income if you qualify to make tax deductible contributions. And like a 401k, funds in traditional IRAs aren't taxed until they're withdrawn. Roth IRAs, like Roth 401ks, don't permit tax deductible contributions, but they allow you to make completely tax free withdrawals under those certain conditions. Since these vehicles are intended to help you save for retirement, a 10% additional penalty applies if you take a withdrawal before reaching age 59 and a half, unless you have an exception that applies. So, any complete financial plan should also involve estate planning. So, let's look briefly at some of the basic concepts you need to understand to achieve your estate planning goals. Here are some of the topics we'll be reviewing. First, we'll look at intestacy and why you may want to avoid it. Next, we'll consider the importance of wills and trusts in estate planning. Then we'll discuss incapacity and what you can do to prepare in case incapacity should strike. Let's say you die leaving $50,000 in a savings account. Who does the money go to? Without instructions from you, the money would go where your state's intestacy laws direct it to go. Intestacy laws vary from state to state, but you can see a typical pattern of distribution. Say half of your property goes to your spouse and half go to your children. Remember, it may be different in your particular state. The biggest issue with intestacy is that your actual wishes are irrelevant. Without an estate plan, regardless of your wishes, your estate would be divided between your spouse and your children. There are many potential problems with allowing your property pass by through intestacy and can be particularly problematic for unmarried couples, since intestacy laws generally will not include an unmarried partner in the distribution of property. There's a very simple way that you can avoid that, though. You can create a will. A will is probably the most vital piece of anyone's estate plan. A will is a legal document in which you direct how your property will be dispersed when you die. It also allows you to name an executor who will carry out your wishes, which are stated in your will. In addition, your will lets you name a guardian for your minor children. You can use your will to accomplish other estate planning goals as well, such as tax planning. But to be valid, your will must be in writing and signed by you. Your signature must be witnessed. And these requirements are important because if you aren't careful, your will may be invalid. So, you want to see an estate planning attorney to take care of this for you and avoid any kind of do it yourself solutions. Finally, let's take talk a little bit about incapacity and how and why you should plan for it. Incapacity describes a condition in which you are legally unable to make your own decisions. Think for a moment what might happen for an example you were to become the victim of a car accident that puts you in a coma for several months. How would your doctor know what medical treatments you would want or not want if you can't speak for yourself? How would your personal business be transacted if no one is authorized to sign documents for you? What would happen is this: someone would have to go to court and get legal permission to do things for you, and that person, who's called a guardian and is usually a close family member, such as a spouse or child. They would have to go back to court every time to get permission needed. As you can imagine, this might be quite burdensome to the guardian. Further, without any prepared instructions from you, your guardian might make decisions that would be different from what you would have decided. Fortunately, these situations can be avoided with proper planning. Healthcare directives allow you to leave instructions without the medical that care that you would want if conditions were such that you couldn't express your own wishes. And property management tools ensure that you can have your financial affairs taken care of for you in the event that you become incapacitated. Once again, an estate planning attorney can help set up what's best for your needs. So that's the conclusion of my presentation. Let me go ahead and stop the recording.